We're looking at an analysis report that's making a very high-conviction, strong buy case for AST Space Mobile.
Right, ASTS, following that recent dip.
Exactly. So the key theme running through this material seems to be this idea that at its current price, around $76.70, this is the last chance to buy before the big BlueBird 6 launch catalyst on December 21st.
And we're here to make sure that analysis is as solid as it can be.
Okay, let's dive right in. I want to start with the financial napkin math section. The analysis report makes a strong case for upside, projecting, $1.2 billion in annual recurring revenue?
Based on 50 million subscribers, yeah.
And using a 20x sales multiple, that gets you to a $24 billion market cap. But then it immediately corrects itself. It says the fair value is actually closer to $50 billion plus, $140 a share by 2027.
And that's based on, quote, global monopoly potential and premium data.
Right, and that's the leap I want to talk about.
Okay, yeah. So, my first point is this. Ensuring the valuation model's leap from that $24 billion to over $50 billion is rigorously supported will significantly increase the report's persuasive power.
I noticed the same thing. Because if you just look at the base case, the $24 billion valuation, well, the market cap right now is already higher than that. It's at $27.7 billion.
Exactly.
So for a moment, the conservative math actually suggests the stock is, overvalued right now.
And that creates this moment of confusion. The weakness here is that the material relies almost entirely on a qualitative promise, this global monopoly potential, to justify a massive, $26 billion plus valuation gap?
Which feels like an assumption.
Outcome. And for a high-conviction thesis, you have to translate that qualitative story into numbers, especially when your own base case doesn't even support the current price.
That's a huge flaw if you're trying to capture an immediate pre-catalyst opportunity. The strong buy call sort of loses its teeth right there.
Right. So the suggestion is to strengthen the connection between that base case wholesale revenue and the premium enterprise stuff. You need to explicitly model the part that justifies the higher multiple.
Show the math.
Show the math. We need to see how $50 billion is achievable, not just be told it's possible.
So when you say modeling, are you just talking about segmenting the revenue or also, adjusting the multiple itself?
It could be both, really. I mean, one concrete way to do this is to explicitly segment those 50 million subscribers.
Okay.
Don't treat them all as a monolith at $2 a month. You could model that, say, 10% of that base is made up of high-value enterprise clients. Maritime, government, IoT.
And they'd be on a much higher ARPU.
A significantly higher ARPU. So if your 45 million subscribers are wholesale, you then model how the remaining 5 million high-margin contracts can structurally absorb that massive valuation gap. That's what gets you to the $50 billion target.
That makes sense. It validates the number.
It completely validates it. Or, another way to do it, you could detail what percentage of the total revenue stream comes from those high-margin contracts. And then you can argue that because, say, 20% of the revenue is sticky enterprise ARR, the whole business deserves a 35x or 40x multiple, not just 20x.
That moves it from hope to math.
Exactly. It provides the missing internal logic.
All right, so if we're talking about the last chance to buy, then protecting the downside is just as important. Which brings me to the risk section. And this binary event.
Yeah.
The material lays out a clear success scenario. The stock jumps to $85, maybe $90 right after the launch.
Okay.
And it also identifies a critical failure scenario. If it fails, the stock could test $50 support. But then you get to the conclusion, and it says the downside is likely capped at $70.
Right, and that's a structural problem. To enhance the credibility of the whole buy the dip thesis, the analysis report has to structurally integrate that massive, stated $50 failure risk with the final projected $70 downside cap.
It's a really big disconnect. I mean, you're telling the reader a catastrophe could send the price to $50. That's a more than 35% drop. But then you say, don't worry, it'll probably stop at 70.
Anyone with deep knowledge is going to see that gap and question the entire analysis.
Absolutely.
The weakness is that the $50 risk factor is identified so clearly, but then it's seemingly just ignored in the final risk-reward math. That math relies on an implied $70 floor. The separation makes the report feel vulnerable.
So you have to explain why you can strategically dismiss the $50 number.
You have to. So the suggestion is to directly address and mitigate that $50 risk factor. Use supporting data, either fundamental or technical, before you settle on the $70 cap.
So how do you best bridge that $20 gap?
Well, the material actually gives you the answer. It mentions in the bear case section that the company has $1.2 billion in cash on hand.
Right, a huge liquidity figure.
It's a critical piece of data that's being underutilized. You can use that specific figure to argue why a drop below $70 is structurally unlikely. That cash provides a tangible financial floor based on enterprise value that makes a full retest of $50 pretty remote, even with a launch delay.
I see. So you use the cash to redefine $50 as a sort of technical black swan event, while $70 is the fundamental floor based on assets.
Precisely. But I wouldn't stop there. To make the argument ironclad, combine it with a technical justification.
Okay.
Provide a technical reason why the $70 floor is stronger than the $50 support. Maybe you analyze multi-year institutional accumulation points or specific fib levels. You reinforce that $70 is the robust floor for the current capital structure.
So it's a dual justification. Fundamental cash floor plus strong technical support.
Exactly. And that builds tremendous confidence in the $70 cap. It effectively neutralizes the $50 threat you yourself brought up, and it aligns the risk with the recommendation. It just elevates the whole argument.
Okay, moving on to the third area. The analysis report does a pretty effective job using technical indicators.
It does.
It notes the loss of the $80 psychological support, the approach to the 50-day moving average, which it puts at $72 to $74, and that technical gap fill target at $84.75.
The technical setup is described really well. It's framed as a classic shakeout, but we need to give this a stronger narrative purpose.
What do you mean by that?
Creating a stronger narrative bridge between the short-term technical shakeout and the long-term commercial significance of Block 2 will solidify that last chance to buy urgency.
Ah, I see. Because right now, the weakness is that the discussion of technicals, the V-shaped recovery, the gap fill, it's presented like it's just chart mechanics.
Almost like geometry, yeah. It feels separate from the core multi-billion-dollar fundamental thesis.
Right.
And if it's just chart patterns, the report risks sounding like a simple trading call, not a high-conviction investment thesis. The technical action needs to prove the fundamental conviction.
It needs to shift from just reporting what the chart is doing to arguing what the chart is. Predicting.
Exactly. The suggestion is to reframe those short-term technical indicators to serve as explicit confirmation that the market is already correcting toward the value implied by a successful launch.
So the dip isn't random. It's a calculated opportunity.
It's a calculated short-term opportunity. Yes. So, for a concrete example, when you discuss that $84.75 technical gap fill, you explicitly tie it to the immediate success target of $85 to $90.
Okay.
You could state that the market's tendency to fill the gap at that level suggests a launch's fundamental significance is already being priced in. The chart is basically screaming that a successful test means $85 is coming.
So the chart isn't just a target, it's showing the market's expectation. If the market already expects $85, then buying at $72 is like securing a guaranteed short-term profit.
Precisely. And then you can argue that buying below the 50-day moving average, that critical $72 to $74 zone, is securing a price point that ignores the near certainty of that recovery. This framing confirms the dip is purely technical and represents a final, clear entry point.